Repo Market will next week trigger the dollar collapse. I'm going to go over that in 3 simple, fast steps. Step number 1, Zoltan Pozsar. We remember the report he came out with December 9th outlining how next week could be the financial system's version of Y2K. But why should we listen to Zoltan? Why does his opinion matter? For that, let's go right to a recent Bloomberg article that was submitted to me by my buddy Jason Burke with Wall Street for Main Street. And if you haven't checked out his YouTube channel, make sure you do so. Let's dive into that article. In 2008, shortly before the collapse of Lehman Brothers, Zoltan went to work for the Federal Reserve Bank of New York, where he became known for creating a map of the financial system that included repo and shadow banks outside traditional lending. Pozsar had such a deep understanding of the financial system that a poster version was pinned up in the New York Fed's briefing room. Pozsar encouraged coworkers to stop by and review it, saying otherwise they'd only be looking at 10% of the overall picture. He then went on to work at the U.S. Treasury Department and landed a job at Credit Suisse in 2015, where he began writing research notes about the mechanics of the Fed's coming interest rate hike. So basically, Zoltan was the guy at the New York Fed that was in charge of teaching everyone how the financial system actually works. That's why when he speaks, the markets listen. Going back to the report that he did on December 9th, let's review that quickly. Zoltan claimed that the financial institutions and the primary dealers that are involved in this financial ecosystem, along with the Fed, would start selling treasuries. They would do this because they'd want to generate the cash to take advantage of higher yields in other markets, such as the FX swap market. This would increase the yields on the bonds or the treasuries because more selling would make the price of those bonds go down. If the price of the bonds go down, then the yields go up because of that inverse relationship. The Fed can't have this because they know that would really crash financial markets like the stock market. So they would have to come in with QE4, print money, and go into the bond market to buy all those bonds that the primary dealers and the financial institutions are selling. What did the Fed do? Well, they saw Zoltan's report, and you can put 2 and 2 together. They won't admit this, but if that's the guy that in 2008 was teaching them about how the financial system works, and that guy came out with a report saying they're basically screwed December 9th, it would come as no surprise that the Fed came out with their own policy change just 3 days later out of pure coincidence, in which they said that they were going to inject more money into the repo market at year's end at the exact same time that Zoltan predicted they would have big problems at year end. And keep in mind, the Fed can't admit that they're doing QE4. Why? Because the economy is built on asset prices, debt, and confidence. That would destroy confidence. So they have to covertly go into the repo market and inject more liquidity in hopes that the primary dealers and the financial institutions won't sell all of those treasuries to come up with the cash they need. And instead, they'll go into the repo market to borrow that cash, then take that cash and invest it elsewhere and get that big return at the end of the year. In their policy response change that they came out with on December 12th, after Zoltan's report on December 9th, they committed to an additional $75 billion repo and upping the overnight repos from $120 billion to $150 billion. The question then becomes, is this going to be enough? Will this provide the liquidity? That's why you have to stay tuned and really pay attention to what's going on in the repo market next week. And I can assure you, I will be covering that. So stay tuned to this channel. You may be asking yourself, okay, George, well, how does that really pertain to a dollar collapse? I mean, I get it. We need to watch out for yield spiking. And if the Fed has to come in here with more emergency liquidity to make sure that the whole system doesn't collapse, but I don't get how that translates to the dollar going down. Insert Luke Gromen. Step number 2, Luke Gromen outlines a brilliant argument for the dollar collapse on the last episode of the Macro Voices podcast. We'll put a link to that in the description below. It all starts with understanding how governments and financial institutions have to continue to roll over their debt. To understand that better, let's go back to that Bloomberg article. In finance, a lack of liquidity kills you quick, says Perry Merling, a Boston University economics professor who co-authored a 2013 paper with Pozsar. How do you not get killed by liquidity? By rolling it over. By saying, I can't make the payment today, I'll make it tomorrow. This is incredibly important, and we'll get to more reasons why in just a moment. But let's remember that the Fed funds rate, or their target range, right now is between 1.5% and 1.75%. But the repo rate spiked in September up to 10%. This tells us that if the Fed wasn't intervening into that repo market every single night by the tune of $120 plus billion, that's what the rate still would be. And the repo rate affects the Fed funds rate. Let's go to this Reuters article that shows us back in mid-September when that repo rate spiked, so did the Fed funds rate. The Fed funds rate affects the amount of interest paid on corporate debt, and that affects the interest rate that the federal government has to pay on all of those short-term T-bills that they're rolling over. All of these interest rates apply directly to the stock market and the housing market, meaning the higher these interest rates go, the lower the stock market goes and the housing market. So if the rates right now are at 1.5%, what would that do to the stock market and the housing market if rates went to their natural level, which is 10% in the repo market? This, among many other things, is what Luke Gromen points out in that Macro Voices podcast. But let's remember, if the stock market goes down and the housing market goes down, so do tax receipts. Editor, let's throw up that chart that shows there's a direct correlation, not necessarily to tax rates, but more so to the stock market and the housing market. The lower the stock market goes, the lower tax receipts go, meaning the money that the government needs to fund itself. Let's shelf that for a moment and focus more on the government and how they roll over their debt short term and how that plays in to the bigger picture. Luke Gromen pointed out that in fiscal 2019, the federal government had to issue $11 trillion in new debt. And you may say, well, that seems impossible when we only have 23 trillion in debt. But you've got to remember that a lot of their debt came due and they have to roll it over because of course they can't pay it. When you combine that with how much debt they have to issue for the deficit, that's what brings us to this $11 trillion issued. Of the $11 trillion, 71% was issued in T-bills with a maturity of 6 months or less. What that means is that the government, within the next 6 months, will have to roll over $7+ trillion. And they will be at the mercy of whatever the Fed funds rate and the repo market rate is at the time when they have to roll over that debt. Are you starting to connect the dots? This brings us to another doom vortex. The doom vortex would work like this. The Fed funds rate goes from 1.5% and it approaches what the real repo market rate should be, and that's 10%. That would implode the corporate bond market, which would implode the stock market, which would implode tax receipts. A lot lower tax receipts plus higher interest rates would mean that the government, when it goes to roll over that debt and issue more short-term treasury bills, the issuance would have to go from 7 trillion, Luke Gromen says even up to 10 trillion. Because they have to issue more debt, that means that the people who are lending them money would see more of an inflation risk, which would do what? Would drive interest rates even higher. To hear Luke Gromen describe this in his own words, let's cut to a clip from the Macro Voices podcast.
What you have is the U.S. government effectively funding itself in short-term funding markets. So if the Fed just let markets work like Powell said he wanted to do, repo would go back to 10% or more, and the U.S. government would need to roll $6 trillion or so in the next 6 months at 10% plus. And the U.S. government cannot afford to roll $6 trillion at 10% plus, especially since at 10% plus, the highly financialized U.S. economy would collapse. So the financing needs would non-linearly go from 6 trillion to 8 trillion to 10 trillion over the next 6 months as tax receipts collapsed. And mortgages would be at 12% plus, so you'd have housing collapsing. Banking system would likely quickly follow. Corporate debt issuance would grind to a halt with repo at 10%. They can't afford to roll any of that stuff at 10% plus. So record U.S. corporate debt issuance would begin defaulting, which with corporate leverage as high as it is could easily quickly wipe out significant portions, if not the majority, of the equity market cap of the United States and the world. And remember, as we've noted multiple times, in the U.S., equity market cap's 160% of GDP, and net capital gains plus taxable IRA distributions alone are around 200% of annual growth in personal consumption expenditures, which itself is 2/3 of GDP. So, in plain English, there's no economy in the U.S. or the world if U.S. stocks crashed. And that's not hyperbole. That's just sixth grade math.
What you may be thinking now is, yes, George, but the Fed would never allow that to happen. They'll come in and print money to make sure that those rates stay at 1.5%. And you would be right. And that brings us to the dollar collapse that we'll get into right now. Step number 3, Luke Gromen's dollar collapse endgame. He believes that the Federal Reserve will come in and print as much money as they need to make sure that they keep the rates down, not only in the repo market, but every other market as well. He references a speech by Ben Bernanke in 2002 where he suggested that in the future, if we have this type of problem, that the United States could just fix interest rates, meaning on the 3-month, the 1 year, the 10-year, the 30-year, they would have a target rate and they would not allow interest rates to go above that. How would they do that? They would print and print and print to buy every single treasury or every single T-bill necessary to make sure that that happens. That would expand the Federal Reserve's balance sheet from 4 trillion to 6 trillion to 10 trillion to $20 trillion. It would be the Buzz Lightyear balance sheet to infinity and beyond. This would put tremendous amount of pressure on the dollar, and it would have to go down in order for the Fed to stop the infinity and beyond balance sheet. Why is that? Because at a certain point, once the dollar gets down low enough, other countries, foreign entities, will be able to afford to come in and actually buy treasuries. Right now, they can't buy that many treasuries because the dollar is so high. Let's use Mexico and the United States as an example. Right now, the peso is 19 to 1, meaning you need 19 Mexican pesos to buy 1 US dollar. Well, if we got to a point where the dollar went down far enough to where you only needed 1 Mexican peso to buy 1 United States dollar, then the government of that country, and it could be Mexico, it could be any country, would then be able to afford to come in and buy a lot more treasuries than they are right now. This would put a bid on the treasuries, and that would decrease the amount of money that the Fed would have to print to keep those interest rates low. And you say, well, George, we could do Japan. Japan's been doing it forever. But you have to look at the demand for a specific government's debt. And in the case of Japan, they have a 30% savings rate. 30. So they don't need as much external demand for their debt because they can finance it internally, meaning their own population can buy that debt. Where in the United States, our savings rate is maybe 3 or 4%, so we just cannot fund that internally. We have to go externally, and that's what puts us at the mercy of all of these countries and buyers outside of the United States. This is the end game that Luke Gromen sees. Basically, the Fed has to expand its balance sheet until it can push the dollar down far enough to where it's attractive for foreign entities to buy our debt. So next week is the Y2K moment. Make sure you're watching on December 31st, and we'll see if the Fed has to come in on a permanent basis and inject even more liquidity into the market. We'll see if Zoltan is right, and if they do, that will be the catalyst. That will be the beginning of the dollar collapse, according to Luke Gromen. It's going to be very interesting to see how that plays out. For more information like this, check out this content right here, and I will see you on the next video and next week for the financial system Y2K.